All right, nearly 2 years after President Obama endorsed the Volcker rule, federal regulators are now moving quickly to make it a reality. Well, yesterday, the FDIC gave its approval of the 298-page draft, and earlier today, the SEC gave its approval. Well, as currently drafted, the Volcker rule is fueling an intense debate. Some saying, of course, that it's going to hurt U.S. banks and their ability to serve their customers. Others say it gives banks still too much freedom. Well, today, we're taking a close look at how it may impact banks' bottom lines, and there's probably no one more qualified than analyst Brad Hintz of Sanford Bernstein. He was once worked as the CFO of Lehman Brothers, also treasurer at Morgan Stanley. Now on the other side of the conversation, which must be quite interesting for you, Brad. But I wanted to get right into what does the rule actually say, and what is the cause of most concern from a bank's perspective or from a securities firm perspective at this point?
Well, it says market making is perfectly fine. It says proprietary trading is not. And unfortunately, proprietary trading is actually part of market making in fixed income. So the rules work perfectly well for an equity division. They just don't work particularly well for fixed income because flow trading, providing liquidity and looking at the patterns of demand in the marketplace, is how you've made money in fixed income for 2 decades.
Now, differentiate between first, because unless you've worked at a bank, you may not know exactly what separates a proprietary trading desk from sort of market making or flow activities.
Well, see, and you're hitting exactly on the point, which is when the rule came out, most analysts and many investors assumed that proprietary trading were those guys who sat in the back office and worked on their own positions, didn't talk to anybody else, didn't talk to clients. They made the bets on the house's money. And this rule is much bigger than that. This rule says that you cannot take too much risk when you're providing liquidity to the marketplace. That these market-making desks are supposed to make most of their money off of the bid-offer spread that exists in fixed income, not the principal transactions, which is the appreciation of the inventory positions.
Now, you did some number crunching in your latest report. I just want to bring up a piece from the report. You said it would reduce revenues by 25% and also cut the pre-tax margin of fixed income by 1/3. So just clarify what that means. Does that reduce revenues overall?
Yes, it does. And it falls disproportionately on certain areas of fixed income. The rules exempt the government bond market. So as a result, you can proprietary trade in governments all you wish. You cannot proprietary trade in non-government securities. So corporate bonds get hit substantially. And that means that if you can't generate great returns in corporate bonds, inventory levels come down, liquidity dries up in the marketplace. There's a lot of secondary effects that roll through here. Now, for U.S. firms, the rules affect you globally. For a foreign firm, it only affects them inside the United States. So unfortunately, what it does is it puts a U.S. firm at a tremendous competitive disadvantage when operating in bunds in Europe and with JGBs in Japan, and because essentially you'll be operating under 2 different sets of rules. Now, they're very serious about this, by the way, because this thing requires senior executives, as in the board of directors and the CEO, to put in place compliance systems and make sure that the culture has changed in the company, that risk managers are not being compensated to go after, to generate profits. So traders aren't going to be compensated on their success in terms of profitability in trading.
Where would you rank this relative to other regulatory regimes that have been installed as it relates to Wall Street? Sarbanes-Oxley, let's talk about the repeal of Glass-Steagall. How impactful is this on the way the U.S. financial services industry operates?
It's a great advantage to European banks. It's an advantage to those smaller brokers who are not commercial banks. So a Jefferies, for instance, is going to have a competitive advantage on this. For those new players who are entering capital markets like an Apollo or a Blackstone, they would have an advantage over the commercial banks on this. I've had clients who've asked me, is this really Glass-Steagall by another name? I don't think it's exactly that, but it certainly changes the economics and will force capital out of the trading businesses into other businesses in the industry.
Now, you say Goldman Sachs and Morgan Stanley, of your coverage universe, are the ones that are going to be most heavily impacted by the draft as it currently stands, right? So 35%, this is the exposure that they had to fixed income and to those market-making activities that would be affected by the Volcker rule. Any chance, now this has started to, some rumors have been circulating, some chatter has been circulating around potentially Goldman Sachs and Morgan Stanley saying, well, I don't want to be a bank anymore. I mean, they sort of only became banks perhaps because they had to during the financial crisis, and they could easily go back perhaps to their prior structures.
Unfortunately, it doesn't work. And that's the, in Dodd-Frank's, there's a clause which has been nicknamed the Hotel California clause. You can check in, but you can't check out. Once you've taken the TARP money under Dodd-Frank, you're going to be regulated by the Fed forever. So Goldman really and Morgan Stanley really can't get out of this. They can change their business model. So a Goldman cannot grow trading as rapidly as they have. By the way, that is not a bad story in terms of ROE because the trading business uses a lot of capital. So, you know, but what's important about this is it's a revenue growth story. All of these large firms, J.P. Morgan, Goldman Sachs, Morgan Stanley, Citi, have grown their capital markets business. It's been a successful business. I throw capital at a balance sheet. I grow my trading business. If the ROEs aren't there, and we've run the numbers on fixed income, based on this draft of the Volcker rule, you get about a 6.5% to 7.5% ROE out of fixed income. Now, you can adjust that. You can bring down compensation. So if you bring down the comp ratio to about 40%, you get closer to an 8% to a 9% ROE. If you shrink the balance sheet by about 25%, you can beat your cost of capital. So it's a real change.
We are joined once again by Brad Hintz, Senior Banking Analyst over at Sanford Bernstein. And Brad, we're so glad to hear. Let me ask you, what's your take on Bernanke? How's he doing?
Well, he took us through a crisis, and we're still here. I mean, this was on-the-job training for everybody in 2008, 2009, right? No one had ever seen anything like this.
And is he doing everything that he can do at the moment, or is he still leaving some stones unturned?
Well, there's a limit to what remember, you're talking to a Keynesian here. So there's a limit to what you can do, right? How do we get consumers to start spending? That's going to be very difficult with a housing market where it is, and that's not an issue for him. He can lower rates, but if people aren't refinancing their homes because their homes are underwater, there's not much that he can do.
Yeah, very true. All right, you mentioned consumer spending. Let's ask about getting investors to spend. If you take a look at the valuations for some of these stocks that you cover, a huge discount to book. All right, whether you're talking Morgan Stanley, Goldman Sachs, et cetera, there's some of the numbers right there. Considerable discount. The average is 1.3. Look at that. Goldman down at what? 0.51 times, or Bank of America 0.51 times book. Have these stocks just discounted in absolute worst case scenario? Are they too cheap?
They're discounting a crisis that would cause illiquidity in the marketplace. Remember, these, at least Morgan Stanley and Goldman Sachs, have mark-to-market balance sheets. So you could buy one of these companies, a tangible book of one, liquidate the trading businesses, fire everybody, and walk away with a pot full of money. Now, that's the logical analysis. The problem is the business models are changing. We're facing a crisis in Europe, and all of that frightens the market. And if we think of the counterparty risk, these are global financial institutions. They touch everybody in the world. So if Europe were to blow up, they may have excellent risk management, but it's certainly going to hurt the stocks in terms of valuation. And I think that's really what you face right now. It's a fear factor. It's not that there's anything that's fundamentally wrong with the companies.
Is that the liquidity crisis that's being priced in, Brad?
Well, it's liquidity in the sense that the market is worried that you could have another frozen fixed income market, and book value valuations really become meaningless when we go to level 3, where it becomes mark to model.
And Brad, we have 2 seconds here. What's your top pick within the sector?
CME.
CME.
Volatility is good with CME.
All right, that was one I wasn't expecting. CME. Brad Hintz from Sanford Bernstein.